I'd like to start discussing the concept of hold rules. And this is probably very new to you, or you've never even heard of this unless you're familiar with the work of William O'Neill. And he's really the only person I know who ever incorporated hold rules into a strategy. And this really demonstrates how important it is to have a mission identified when you're starting an investment strategy, because unless you're aware that you're trying to capture these growth stocks for these enormous moves, you wouldn't necessarily have a hold rule whatsoever. So the hold rule is really to help prevent you from selling a major winner too soon. What it does is it objectively turns off your ability to sell. Again, you're never going to have a hold rule preventing you from selling a stock to minimize losses. Whenever you enter the loss column, that's risk management. Nothing overrides the risk management. But when you're sitting with a profit, it's very difficult to hold on to a winning stock. You constantly see like all this downside the stock can have to a moving average, or if the market, something negative news comes out, what could happen. So it's difficult psychologically to sit in this big winner with all this profit that you want to realize. And this hold rule gets the job done in having you have to sit with the stock. Another important aspect of hold rules, besides helping you avoid selling an advancing stock too soon, is it prevents you from overtrading soon after your purchase. So there's a couple of hold rules that I developed myself, because I think, coming from my background of being a market maker and pro trader and trading so much, sometimes I kind of get ahead of myself and I'll sell a stock if there's no action right away. I think that's the opposite problem a lot of people have. I think most people probably have the issue whereas they're too slow to sell. I'm often too quick to sell. And so I designed a really simple rule for that as well, which we'll cover. But again, I just want to discuss the two biggest mistakes you can make as an investor. The first is taking losses that are just way too big. But the second big mistake you can make is really selling a major winner for a small gain. And they don't come around too often. You need to have a lot of really good conditions in terms of the stock market, that stock, your understanding of the company come together for you to capture that move. So selling a major winner too early is really a major mistake. And it's nearly impossible to know which of your stocks are going to be the major winner before you start. I mean, everything we're doing here is to try and find major winners. All of these great stocks are going to have strong fundamentals, great technical criteria present when you buy them. But that last confirmation that you need is really the market reaction. How the market acts after you make that purchase tells you whether or not the market is agreeing with your thoughts on this stock. And the faster the market recognizes that the stock should be worth a lot more, all the more powerful your original idea was. So each signal here is really designed to come in at a key point as well. I mean, we discussed all of these tools are really studying the demand and supply equation. We're looking for where that break above supply happens, where that equilibrium is reshifting higher. So a stock that fails to advance quickly is a sign that there isn't really a strong pressing demand, or there's enough supply that the story is not fully accepted and acknowledged in the marketplace. So when you buy a stock, if you're really in at the right time and everything is lined up, it's a great stock with a great story, with a great runway, you should have a great market reaction. Because at the end of the day, as we discussed in the selling, people with deep pockets, big institutions, they have a lot of tools at their disposal, like those satellites studying parking lot images that we don't have. So if the stock starts to advance very quickly, perhaps they have information coming in with even more pressing demand, pushing them even faster to buy this stock. So that's why the market reaction is so key. It confirms your overall thought process, and it confirms that you're buying at the right time, and it's worth holding the stock for a longer move. These hold rules, like other patterns, are really a result of studying past market winners, and they naturally trigger when the market and investors acknowledge the potential of the company. Now, although holding these stocks and these major winners is the goal of what we're doing, some people just psychologically can't deal with the fact that they're going to give back so much profit if the stock doesn't develop into this huge advance. So I think a logical amendment is to sell 25% of your position if the stock advances by 15 or 20% or 25%. I think there's no magic number there. Some people like to use 20 or 25 or 15. I think what's most important is that you're consistent. So if you think you're going to sell 25% of your stock when you're up 20%, you have to do that for every stock that you purchase that advances is 20% to keep your results consistent over time. Myself, that's not what I try to do. I try and really keep adding to my winner and keep myself in that bullish mindset, and instead of considering selling, try and think about how I'm going to buy more stock. But I understand if that heavy position and that volatility of your account is going to work against you holding the stock altogether, you're better off working with your personality, taking a little bit off, And as you grow with experience, as you grow with comfort of holding stocks for longer moves that are concentrated in these stocks that may have more volatility than you're used to, with time you can go back and say, okay, I can understand why this hold rule exists. I'm willing to hold a stock even if it advances 20% and then pulls back 10 or 15%. And with time, as you become comfortable with that, maybe you'll do away with selling a little bit into strength. But if not, if it's really a deal breaker and trying to live with this technique, then I'd say take a little bit off, a quarter into strength, and that'll help you to hold on for the rest of the advance. So let's dive into some examples and let's get a sense of how these hold rules will help keep us in these major winners and what the criteria are behind them. Let's take a look. The first hold rule that we're going to look at is directly tied to how William O'Neill used it. And this is really why it's so important that your entire mission, your entire strategy works cohesively together, because this hold rule is directly related to the shaper patterns. So if you're breaking out of a shaper pattern at a shaper pattern buy point, that essentially starts a clock, very similar to when we break highs or lows for our shake in and shake out patterns. And once you break out of that pattern, if you advance 20% in 3 weeks or less, that's a stock you need to hold at least 8 weeks. Now, all the criteria needs to be there. You have to have this great shaper pattern. You want to see a breakout with some good volume, and you see that advance. That's really telling you you're onto something major. All the characteristics are there of the past huge winners, and you have to wait 8 weeks to see how the stock performs. The reason for the 8 weeks is that simply once you advance 20% 3 weeks, you're probably going to consolidate. And just about the time it's done consolidating, you're likely to want to just sell that stock and take whatever profit you have left. And this hold rule really forces you to say no. The bigger picture is we broke out of the shaper pattern, we advanced strongly. This is that first normal reaction, normal pause that I have to sit through if I want to see a major advance. And at the end of that 8 weeks, you can reassess. And if at the end of the 8 weeks, this proved to hold itself and it's remaining a leader versus the market, then you switch and you only use shaper cells. Again, we discussed this earlier with the shaper cells, and you're really going to be using only those shaper cells once they start to trigger these hold rules, because now you know you have this major winner and you don't want to be selling just on a tactical basis to lock in a bit of profit. You want a shaper cell to come in and show you that it's probably the end of the trend. And so that hold rule does really two things. One, keeps you in that normal pullback, and two, really alerts you that you have a major winner, and now it changes the type of sell signals you can use on this stock to keep you in this stock for longer. So let's take a look at booking.com, which we covered earlier, and see how this hold rule would have helped keep you in the stock for its major advance. Here we have that same great cup and handle in 2006 that we looked at from multiple angles at this point. And you can see we broke out of that cup with handle, and from the day we broke out, the stock advanced 20% in only 3 weeks. And so that means you need to hold for a total of 8 weeks. Once we had that 20% in only 3 weeks, the normal market action occurred, and we had this first normal pause in trend that pulled back to that 10-week, or in this case 50-day moving average. And as you'll see here, the 8-week time limit basically came up right in this region. And so that's really where you start to assess, did the majority of the gains hold? Are we still showing to be a leader? And in this case here, we broke out, we held the advance. There's no extremely negative downside volume or significant breaks. And so that really means that, okay, I have identified that the market recognizes we may have a major winner on our hands, and we have to only use shaper sell signals to exit this stock. And so rather than being frustrated as the stock pulls back and selling, that mindset actually has you realize, oh, wait a second, this is the first test of the 10-week moving average after the expansion from the base. So whereas most people would be selling in frustration, you would be here getting ready to add to this stock. And this is really the best example of how this all comes together. And you see, we start to advance from there, and it doesn't scream higher immediately, but eventually you really kick into high gear on the next earnings report, and it becomes a major winner. And that's really how your buy rules and your hold rules really come together to keep you into a major stock. This is Fastly. So this is a stock that I'll speak to from experience. I had this great breakaway from this cup with handle, which I began purchasing here in May of 2020. And this very quickly had a 20% gains in only 2 days. So this is basically became the situation where I won't lose money on this stock anymore, but I need to hold the stock for 8 weeks because I may have something really significant. And in this case here, it didn't have to make you necessarily sit through a major correction, but it had to force you to sit through this major advance. It's extremely difficult, believe it or not, that when you buy a stock at high 20s, and very soon after you're at $60, and you have to be hold on to this position. You cannot sell it, and that's really what helped me stay into this major winner. 8 weeks later, you identify that's a major winner, and you have to use only shaper sells to exit the stock, which eventually started to show up a little bit later on. It didn't advance significantly higher from this point, unfortunately. However, it did keep you in for the large majority of this advance. So mission success. Here's an example of sometimes how it's not 100% clear as to where you're going to start that clock. It could be that sometimes you're a little bit confused. I just want to show you an alternate technique. Again, just because it doesn't trigger the hold rule immediately, it doesn't mean that you can't hold the stock. If you believe you have a major winner and it is acting strongly, you can make it your plan to use only shape or sell signals. However, sometimes I think the real key is that you want to see that 20% in 3 weeks or less from where the expansion phase of the stock begins. So we did break above this double bottom, but essentially you went to a little consolidation on the right side of this double bottom as it came, it had a substantial run off the low. It's normal to take this pause. And you could basically view this as a double bottom with a handle. So basically one last pause before we advance higher. And so you can see once we broke out of the handle area, we did have 20% in 3 weeks. So this is really the first point where you had expansion out of the basing general structure. This is kind of one of those nuances. I mean, if you didn't view it that way back at the time, it's understandable, but it's something I think you should be aware of, that it's really where that expansion phase begins. If you're not sure, you essentially just want to go back to where that, easily identify initial breakout point would be to start your clock. But the logic test is really, do you have a possible major winner? That's really what you're trying to identify here. So if ever you're unsure, go back through that thought process. And Lululemon really was changing the way women's athletic apparel and now also men's as well, but was used, and it became really everyone around was wearing Lululemon type yoga pants. And this really kept you in for this major advance and had you sit around 8 weeks, right until the end of this correction. And this went on to be a major, major winner. And so again, the hold rule really kept you in through that first pause. And then after identifying that you had a major winner, waiting only for shaper sells kept you in for the majority of that Lululemon advance. So another great example of how the hold rules really helped you reach your mission objective. Here is C Limited. Going back to another example, I really want to try and use the same stocks in multiple sections of this course so you can really see over time how this all builds together. You'll have all of these charts in your course pack, so you can print these out and really maybe take the same stock and make a grouping of it and see how all these different factors work together. I really recommend that. But you can see here we broke out of this nice cup with handle base. This was that mini coil we spoke about in the tactical buying section, and you had 20% in only 2 weeks. And so you had this very strong advance. 8 weeks later, you have a major winner and you have a large profit cushion, so you have to wait for only shaper sells. And again, this really had you buying on the first test of the 10-week moving average. I don't have the 10-week average here, it's only the 50-day, but there's another good example of why I use the 10-week. It tends to be just a little bit higher than the 50-day, and I do remember buying this stock on this day, so I do know that it hit the 10-week moving average. Here is Shopify, and this was that drop into 2018 into early 2019 that we covered earlier, and this was showing the major relative strength. You can see Shopify was sideways as the market kept falling. Once we had our shakeout plus 10% buy point, we advanced 20% in only 3 weeks, which meant you had to hold this for 8 weeks. And once we got here, this was clearly a major winner of this trend. And we had our first buy of the 10-week moving average, and we then eventually went substantially higher. And I think most people, having bought here, if you didn't have that hold rule, would have been very easy to just kind of say, oh, look, I'm back at old highs. Let me take this quick profit. It's rather substantial. But if the real aim is to cash that monster winner, if you got your hands on a shop before it advances several fold, selling for a small profit is the last thing you want to do. So again, all of these tools coming together is a very powerful system. The second way I like to use hold rules is really just an amendment to the 20% in 3 weeks that we already covered. It's along the same logical basis. Through my own experience, I realized that sometimes you want to, again, use the real logic of what you're trying to accomplish. So sometimes the market may be weak and be holding back a stock's advance. So if the stock is showing extremely strong relative strength, I want to relax the criteria for holding that stock. So in this case here, if a stock is emerging from a first or second stage base and it's up only 15% in 4 weeks rather than 3 weeks, but is exhibiting strong relative strength, that 2-point relative strength that we covered earlier, that AB relative strength, then you want to hold it for 8 weeks regardless. So I think some examples will be the best way to visualize. So you can see here, this was Lululemon in 2018. We broke out of this flat base and we advanced 20% in 4 weeks. However, so that was past the 3-week threshold we would normally use. However, you can see here, the market was making lower highs during that entire period while the stock was pushing higher. I would argue very strongly that if it wasn't for such a weak market, Lulu would have been significantly higher prior to this later on gap up, because clearly this was under accumulation the entire time. So 8 weeks later, Lulu remains a major winner, and now you have to wait only for shaper sells. So again, rather than selling, you're getting ready to add on that first touch of the 10-week moving average, and this really develops once again into a major winner for you. So this is a major winner back in 2010 and another major winner in 2018. Here is Square. Another example here is where we broke out of this base and we advanced 20% in 4 weeks. However, as Square was advancing, there was a rather sharp pullback here in the market. And you can see the market here on this pullback essentially erased that whole prior uptrend just about. And you can see Square was significantly higher than the breakout despite this rather initial steep drop. So sometimes, again, it's a small difference, but you always want to pass that same logic test. Do I have a major winner? Is this showing me something special going on? So at the end of the 4 weeks, you have a 20% gain. You want to hold it for at least 8 weeks. At the end of 8 weeks, you realize you want to use only shaper sells to sell this stock. And rather than selling here, you're adding on the first touch of the 10-week moving average. And again, this turns into a major winner thanks to that hold rule. Here is Southwestern Energies. This is a major natural gas stock advance back in 2004. We had this flat base. Swan starts to advance, and really it does 20% in only 6 weeks. So what do we do in this situation? Do we sell it? You could, and it'd be perfectly reasonable. You could say you have a multiple of your risk. I just want to show you why I developed this slight difference in the hold rule in the first place. Again, this is if the stock is showing extreme relative strength compared to the market. You can see the market here was extremely weak over that period. The entire time that Southwestern Energies advanced, the market was essentially falling. Did you have to hold it for the 8 weeks? It would have helped keep you through this initial pullback. Maybe you did not, but this is really a matter of where you want to start making some portfolio management. If the rest of your account is sold because of market weakness, and this is your one remaining winner, and is showing such strong relative strength, that, in my point of view, would be a reason to say, look, this stock, I'm going to give it a little more time because it's so strong versus the market. There must be something going on here. And Southwestern Energy goes on to be a major, major winner. So if you would have sold this for a very short-term profit just because of market weakness, you eventually missed out on a substantial advance. There's one exemption I want to speak about, and that's the IPO hold exemption. So if we come out of an IPO base and you advance 70% or more in only 2 months, you really want to take that profit. You want to sell into strength. The reason is most stocks that are recently IPOing are going to have a lockup expiration. So what does that mean? Well, a lot of insiders who own the company prior to it going public cannot sell all of their stock within a certain window of time from going public. As that window expires, you usually kind of have a rush for insiders to sell that stock so they can take advantage of that very inexpensive stock that they own and realize that profit. And that usually puts a strong weight on the stock price. Also, you tend to have a very sharp rise soon after an IPO base because the float, the number of shares available for trading, is so small because of that lockup expiration. And as a result, any fund or any people who want to buy that stock have to kind of pay higher up because there's very little stock available to purchase. So you usually have an exaggerated move up initially, and after an exaggerated move down after the expiration as people exit. And so I've noticed myself, if I can get a very strong advance out of an IPO base, rather than being forced to hold for a long term, I call it the exemption. You really just want to sell into that. And InMotor is a good example. This IPO'd in 2019, and we formed kind of like a high tide flag here. We broke out and we advanced 100%, and you really want to sell into this. And eventually we went substantially lower, retracing the entire advance. Here is Tesla, but this is Tesla early on in its debut in the stock market. And you can see you had your IPO, you broke out of this coil wedge here, and we advanced 70% relatively quickly. and you really wanted to sell into that, and it eventually came right back down. So that's just an example of how important it is to sell after an IPO has a very strong advance. You really want to lock in those gains before insiders take them away from you. The last hold-related rule I want to discuss is something that I alluded to earlier, whereas in my background, because I used to trade so much as a short-term trader, it's not always easy to sit in a stock. Again, it's probably the opposite problem that most people have. But this is an example, one, of a rule that can help you with if you have a similar problem, and two, how you can build a rule to offset one of your own personal weaknesses and take that out of the equation so you could be more successful. Again, the 3 exponential moving average is really a short-term tool that I use when I need to take a step back and just time something on a very minute basis. And the way this started to work for me is that after I'd buy a stock, oftentimes if there wasn't a strong advance, I would flip it out and chase another idea, which is the wrong thing to do, and it's just a bad impulse. So I came up with the rule, if once I buy a stock, if it doesn't hit my stop loss on the bottom, which is usually tight to begin with, I have to at least wait 5 days unless it closes below its 3 exponential moving average. So the logic I noticed after many of these quick trades that ended up becoming winners was that if I buy a stock and I'm not losing money with my tight stop loss, and I'm not even closing below the average of the past 3 days, essentially I'm just way too jumpy. I need to slow myself down, I have to wait, and I need a line in the sand where I can't sell. And so when I buy a stock, I start a 5-day clock, and it has to close below a 3 exponential in that period for me to sell it. So if we take an example of Pinterest, we had this mini coil here, and we broke out of this mini coil, we stalled at prior highs, and we came right back down, and this is actually an error I made, and unfortunately I made it. But I sold on this day down here. I said, oh, there's no follow through, let me get out. We closed below the 3 exponential moving average, but there was no follow through the next day. So if it closed below that 3 exponential, I would have needed to take out the low of that bar to confirm that the stock can be sold. Doesn't mean you have to sell it, but if you have that impulse to sell it, you cannot sell it unless it closes below a 3 exponential and takes out the low of that day. So again, it breaks out of the pattern. I start my 5-day clock, so day 1, day 2, day 3 closes below, so that would have been the earliest I could sell would be the low of that bar, and it never would have happened, so I would have still been in the stock. Instead, I had to reposition myself later on. So it's just a great way to kind of force you to stay in after you buy a stock. Here's another example of Snap. We had this kind of cup with this little low handle. We broke out, we snapped back in, and this really is usually how it tends to get me in the past and why I came up with this rule. After you buy a stock, if there's a good expansion day up, very often there's kind of like a little retest, which is just normal. Again, there's short-term traders in the market, long-term traders. Sometimes those short-term traders have this nice move up and they sell into it and causes that short-term weakness, and it's just a real pause before the stock advances significantly higher. But if you didn't have this rule in place, if you would have bought this stock and then after sold prior to it hitting a stop loss or one of your exit criteria just because, oh, it's coming down, that would have been a major mistake. So we break out on this bar here. Day 2, we close below the 3 exponential moving average, but the low of that bar is never broken. So you cannot sell unless you're either at your stop loss or you close below that 3 EMA and take out the low of that bar. So this is a hold rule that would have kept you in again for that initial pullback before we went higher. Here we have Twilio, very similar. We broke this 3-touch trend line and we had a really quick snapback right after that. So if you were impatient and said, oh, I got to get out of here, instead of waiting for your stop on the low of the prior bar or wherever your dollar stop would be, if you just exited, it was a big mistake because you had that initial little pullback after that little expansion. It closed below the 3 exponential, but never broke the low of that bar. So you would have still been in for this advance. And if you would have been impatient, you would have been sold out right before the stock started to move higher. Here's Zoom Communications. We broke the prior low, setting up a very nice 3 EMA shakeout right around the 50-day moving average. We closed above the 3 EMA right here, and we were triggered long. And that same day, we kind of stopped and reversed lower. So if you were frustrated saying, oh, I bought above the high and we pulled back right away, this is probably not a good stock, let me just get rid of it, you would have made a major mistake. It was just a normal little pause after 2 days up. And so by waiting for a close below the 3 EMA, here in this case we didn't even close below it, it just kind of gets back into the vicinity of it, but you would have been forced to stay in it. And we had a quick rally up, and even here we closed below the 3 EMA, but the low of that bar was never taken out. So if you're still using that very short-term tool, you still would have been forced to stay in here. And that's, especially when I'm in a stock that's moving rather quickly, if I'm feeling that nervousness where I want to take that profit, or I think there's maybe a climax top, or I'm not quite sure, I always try and calm myself down if I'm above a 3 exponential moving average. I mean, I stop and think I'm above the average of the past 3 days. We're not exactly in a bear trend here. So it's a great way for me to kind of just cool myself off and realize that I'm getting a little bit ahead of myself in my thinking. So now that we have all of our buy rules, we have all of our sell rules, we have all of our hold rules, let's begin putting it all together in one section so you can see how all of this really comes together with some specific examples. Let's take a look.